When we talk about money printing, most people imagine stacks of brand new bills rolling off some government press. But that's old school. Today, money creation happens behind the scenes, mostly digitally. What we're witnessing today is not just the result of interest rate manipulation, but a much bigger hidden force that drives the value of everything from your savings account to your retirement portfolio. You've probably heard of the federal funds rate, the benchmark set by the Federal Reserve. But when we look at what's happening in the markets, especially since the financial crisis, it's clear that interest rate changes don't tell the whole story. So let's dive deep into what's really going on. First thing you need to know is something called the money supply. Think of this simply as the amount of money available in the economy. Economists categorize different types of money based on its liquidity, how quickly it can be turned into cash. The most common measure you've probably heard of is M1, which includes accounts like checking and savings and the physical cash out there. Now, while M1 is important, it doesn't paint the full picture because it leaves out things like money market accounts or certificates of deposit, which are also considered pretty liquid. That's where M2 comes in. It's a bit broader, capturing money that's slightly less liquid than M1. Basically, M2 includes cash, checking deposits, and easily convertible near money, like money market accounts. The key point here is that both M1 and M2 have been growing exponentially. Since early 2022, M2 has surged from around $21 trillion to well over $23.8 trillion as of May 2025, according to data from the Federal Reserve Bank of St. Louis, Fred 2025. In fact, the rate of increase is faster than before the pandemic, leading us to ask, why is the money supply exploding, and what does it mean for you? Well, think of the money supply as a balloon. When you blow air into it, it expands, right? Similarly, when more money enters the economy, either through government spending, central bank actions, or commercial bank lending, the money supply grows. Lately, we've seen all three of these forces in action. First, continued fiscal stimulus, meaning government spending. Then second, Fed asset purchases, injecting liquidity directly into the markets. And finally, third, ongoing efforts by the Federal Reserve and other central banks to keep the markets well lubricated with cash. So why is all this money being pumped into the system? Simply put, to stabilize the markets and avoid recession. Since the pandemic, governments and central banks have taken unprecedented steps to support their economies and financial systems. Low interest rates and direct infusions of cash into businesses and individuals have become common tools. But the big question is, where does all this extra cash go? Remember our balloon analogy? If you keep blowing air into it, it's bound to burst at some point. But in the world of finance, it's not quite as simple. Instead of bursting, the balloon expands, pushing asset prices up across the board. We're seeing this play out in the stock market. Major indices have hit record highs, despite ongoing geopolitical tension and economic uncertainty. Gold prices are also soaring. After staying relatively flat for nearly a decade, the price of gold has climbed from around $1,700 per ounce in early 2022 to over $2,000 in mid-2025. This surge is driven by several factors, including the weak dollar, ongoing conflicts, and central bank buying. But it's safe to say that the expanding money supply is playing a role too. Finally, let's talk about Bitcoin. The cryptocurrency has had a meteoric rise recently, crossing the $100,000 mark, becoming the first and so far only asset to reach this milestone. While Bitcoin's price swings are notoriously volatile, its long-term trajectory reflects the same forces driving other markets higher. Now, you might be wondering, why hasn't inflation skyrocketed with all this extra cash in the system? Well, it's all about what economists call the velocity of money, basically how quickly money circulates in the economy. If everyone starts hoarding cash, inflation will stay low. But if money circulates rapidly, prices could soar. Right now, velocity remains low, keeping visible inflation under wraps. Let me explain this further. Imagine our economy is a big highway with lots of cars zooming around, representing money circulating. If all the cars stay parked in one place, traffic isn't a problem. But if they start moving, congestion builds up. This is much like our economy. When money sits in bank accounts without being spent, inflation stays low. But when it moves quickly into investments and spending, it can push up prices. Several factors are keeping the velocity of money low, like ongoing geopolitical risks and uncertainties. People and businesses tend to hold on to cash during turbulent times, delaying major investments until things settle down. Additionally, the massive debt burden on both personal and national levels adds another layer of caution. High debt means higher interest payments, leaving less money for discretionary spending and investment. These dynamics are likely to change over time, though. As the global economy stabilizes and excessive debt burdens ease, money could start circulating more freely, potentially accelerating inflation. Here's something else to consider. Rising asset prices might seem like good news, but they're not exactly making anyone richer. Take stocks, for example. Sure, having a stock portfolio that's skyrocketed in value sounds great, but unless you sell those shares, that gain doesn't really mean anything. In fact, when you sell, you might trigger a chain reaction leading to a market correction, which could wipe out those gains. That's why the real wealth is often in the assets that keep going up in value. Real estate, for instance, has benefited immensely from all the extra cash sloshing around. House prices have risen dramatically in recent years, turning a $300,000 mortgage into a $500,000 property. For those who bought early, this trend can lead to substantial wealth generation. But it also means that young buyers entering the market are shouldering way more debt just to get a foot in the door. In essence, we are re-seeing a transfer of wealth from those who save and lend money to those who borrow and invest in assets. Those who are able to take advantage of cheap loans to buy appreciating assets are getting super rich. Think of Jeff Bezos buying tons of warehouse space in the early days of Amazon, or Elon Musk buying property for Tesla charging stations. On the other hand, savers are watching their cash lose value without any real way to grow it. Some might argue that all this extra money is necessary to keep the economy afloat. In a world of high debt and complex financial instruments, a bit of stimulus here, a bit of intervention there, might seem like the only way to prevent a collapse. But at what cost? When we keep pumping money into the system without addressing the underlying issues, we're essentially putting a band-aid on a bullet wound. We're not solving the root problems that led to the financial crisis in the first place. Consider this, according to a report from the Bank for International Settlements. Global bank lending increased by 3.5% in the first quarter of 2025 alone. That's a staggering amount, and it shows that the liquidity isn't just sitting idle. It's fueling growth in various sectors. Is this growth sustainable? Well, that depends on whether the underlying fundamentals can support it. If not, we could be facing a reckoning, sudden economic downturn, a spike in defaults, or even a shift in investor sentiment could trigger a chain reaction, leading to a sharp market correction. Take commercial real estate, for instance. With interest rates still near historic highs, many commercial landlords are struggling to make their loans. If a bunch of them default, it could send shockwaves across the entire real estate market. And that's just one sector. There are countless others with similar vulnerabilities. And then there's Bitcoin. It's like the wild child of the asset world, rallying hard but also crashing spectacularly. Just take a look at its price history. We've seen parabolic rises followed by brutal drops. So while Bitcoin's recent rally is impressive, it's essential to remember that past performance isn't indicative of future results. In fact, many analysts predict a potential Bitcoin crash due to overvaluation. If that happens, it could drag down other asset prices along with it. Now let's shift our focus to gold. Despite being hailed as a safe haven, its price is also influenced by market sentiment. Central banks buying gold isn't just about diversifying their reserves, it's also a signal of confidence in the metal's stability. But what if investor sentiment shifts? A sudden wave of selling could drive gold prices down, undermining its reputation as a safe bet. Simply put, the markets are on thin ice. They're propped up by cheap money, but without solid fundamental support. The party might be going strong now, but the music's bound to stop sometime. And when it does, all the inflated asset prices could come crashing down. So what should you do? Well, let's start with a disclaimer. I'm not your financial advisor, so take everything I say with a grain of salt. But here's my 2 cents. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. Right now, the markets are in a euphoric state. Everyone's talking about AI, electric vehicles, and the latest biotech breakthrough. But how much of this excitement is justified by actual fundamentals? Take the AI frenzy, for instance. Many tech companies are slapping the AI label on their products regardless of whether they actually use artificial intelligence. It's become a marketing ploy rather than a technological differentiator. That's just one example. There is so much hype around certain sectors that it's hard to separate genuine innovation from clickbait headlines. What's the solution? Well, for starters, educate yourself. Don't blindly follow the crowd into investments just because they're trending. Do your research, read financial reports, and understand the businesses you're investing in. Diversification is another powerful tool. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes to reduce your risk. Finally, consider consulting with a financial advisor, especially if you're unsure about navigating the markets alone. One last piece of advice: stay calm. Easier said than done, I know, but panic selling is almost always a bad idea. When fear takes over, people often make irrational decisions that they later regret. Stay level-headed and stick to your long-term financial plan.